Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in this episode, I'd like to talk about hotspotting versus buy and hold. So last week we spoke about property investment strategy. This week I'm going to talk about hotspotting. And I think it's really good to think about the different property investment strategies that are espoused or talked about in different sectors of the market and really stand back and financially analyze them. And don't forget, I'm independent. I don't really care. I don't have a vested interest in how we go about using property to build wealth. It's really my job is to identify the approach that has the highest probability of working that fits in with my clients' strategies. And that's really my job. So independently of the people that talk about these sorts of strategies, either they've got a product to sell or a property to sell or something like that, that's their business. I think it's important to point out I don't have a dog in the fight. I'm just an independent person sort of analyzing it. So hotspotting, let's talk about that. And the reason why I want to talk about it is that I've seen more and more buyers agents posting on social media, kind of showcasing short-term returns for their clients. Like, I bought this property 4 years ago for 550 grand and now it's worth 850,000. What a great outcome. Of course, I'm not throwing stones at that. I think, of course it's a great outcome for the client and it's a great outcome for the buyer's agent and so forth. But, Howard Schultz, who built the Starbucks, I should say, empire, had a fantastic saying, which was, short-term profit really drives long-term value. And it's true, I think, with many things. I mean, he was using it in the context of business in that, sometimes, reinvesting in your team, reinvesting in the store, getting better at your job, it might hit profitability in the next quarter, but in the long run, it generates business value. And I think the same, so that's the context he was using that term in. But I think it's the same with investing, right? It's all about asking ourselves today, what can we do over the next couple of years so that in 10, 20 years, we look back and go, yeah, that was the best decision I could have made back then, as opposed to, it's really tempting to, I guess, respond to this kind of clickbait marketing to say, oh, look at that return. I want a piece of that pie. That property's increased $300,000 in a relatively short period of time, and we're off to the races. Now, again, I'm not throwing stones at it. It's a great outcome. The question when I look at those posts is that's great. What will the returns be over the next 20 years versus an alternative? And that's really what sort of, I guess, started or gave me the idea for this podcast episode. Okay, so I guess we should start about talking what is hotspotting and how does it really work? And of course, different people are going to have different strategies or different ways of putting it. But essentially, hotspotting is buying in a new growth area, a location, usually a suburb, that is expected to enjoy above average demand for housing and therefore above average price growth. It's typically in regional locations or sort of outer suburbs of capital cities. So hotspotting is not really going to be a blue chip location necessarily. In terms of price points, these properties tend to be around sort of 4 to 600,000. And they tend to offer higher rental yields, maybe because they're intrinsically undervalued, maybe because the past capital growth hasn't been so fantastic. And the premise behind the idea of hotspotting is that future returns will be much better than past returns, which I guess adds an element of risk there. And it's a really attractive proposition to market, of course, because we're at a price point that is relatively affordable. We've got a higher rental yield, so holding costs will be a little bit lower. And because of a lower price point, most investors feel like, okay, I've got less on the line. Whereas if I go and buy something for $2 million, that's a lot of money in one asset. Actually, that's the emotions to it. The fundamentals are actually flipped the other way. That, if you're buying a much better quality asset, you should actually feel more confident. But of course, the emotional element is we've got more money on the line, so there's more perceived risk. Now, of course, the challenge with hotspotting is pinpointing locations where prices are just about to take off. That's not always an easy thing. Now, buyers agents tend to rely on demographic data like household income, population growth, migration patterns as kind of potential, hopefully leading indicators. of future price growth. They also look at growth drivers like infrastructure projects, economic development, government incentives, these sorts of things. So they're looking at those sort of macro trends that might affect property prices in a particular location. Now, there's a couple of challenges with this sort of data-driven approach in terms of helping making investment decisions. Firstly, the data tends to be out of date. It's very difficult to find reliable demographic data that tells you what's happening in a location right now. Quite often, if it's from the ABS or even older, census data, it could be 1, 2, 3 years old. So that means we really need to think about, is this leading data or actually is it lagging data? Is it telling us what has happened as opposed to what is happening now and what might happen in the future, which is leading data? So that's a challenge. And secondly, the firms, these buyer's agent firms, there's only a limited data set, right? They're all got the same data set. So it can be difficult to find a competitive edge in terms of identifying a location, whether you're doing it individually or the help with a buyer's agent, identifying a location that no one's ever heard of yet, no one's ever thinking about. It's just about to take off and you can get in there early. Now, one of my biggest concerns with hotspotting is it can be a self-fulfilling prophecy. That is that I'm aware of situations, for example, most recently in Perth, where buyers agents have been buying in outer suburbs sight unseen over the past couple of years. They don't even have boots on the ground in terms of, or not even, and particularly, as Campbell recorded a podcast a few episodes ago about finding a great buyer's agent, you really want to have that local area expertise. Well, in that situation, they certainly didn't have it. And the one that I'm aware of, local agents quickly caught on that this buyer's agent was keen to snap up any properties with very limited due diligence. And so it made it really easy for them to sell additional property to this buyer's agent. And then naturally, vendor expectations increased, with each price point or each sale, there was hope that we could get more and more and more. And then the buyer's agent used that data to go back to new clients and say, look, I've been buying in this area, prices are up 20%. But the challenge is, who has been driving this price increase? It was in this situation, this one firm that had, quite a supply of new clients to get into a particular location, but they were the market pretty much, and they were driving that market. So really, it's important to understand then what has been driving growth. If we're getting into a particular market, is it real and sustainable, or is it really just artificial demand driven by a handful of buyers agents or a handful of buyers? As an investor, we want to know that a location is genuinely going to benefit from a diverse buyer pool. It can't be just interstate investors. It can't be just investors using a particular buyer's agent firm. And the same thing with hotspotting reports. Sometimes online you can buy these hotspotting reports. Same sort of thing, what is going to drive this demand? Is it just the report? And once the report changes next month, and then all of a sudden people jump off the bandwagon, and that's not really going to be sustainable. So the key is you want that genuine multifaceted demand where both owner-occupiers and investors are buying, particularly those that live in the same state. So again, you don't want just interstate buyers just driving that market because it can be a bit risky and a bit challenging, of course. But my biggest fundamental challenge or problem with hotspotting is that if we're buying in secondary locations, they simply cannot sustain above average price growth over long term. So, what I want to do is go and invest in a property and hopefully hold it for many, many decades. And what I want is my average return over that many, many decade period to be as high as possible. Now, if I'm buying into a secondary location, yes, any location will outperform it. There's going to be a handful of locations over the next 6 to 12 months or 5 years that will outperform and outgrow some blue chip locations. That happens. But I'm not really worried about what will the price growth be over the next 5 to 7 years. I'm really worried about what will the price growth be over the next 20 years. And the reality is that if I'm buying a secondary location, that price growth has to be linked to affordability. Because what happens is that property prices grow in a particular area, and then they get to a point, and then there's some new land that's released a little bit down the road, And all of a sudden that looks relatively cheap and the buyers then start to spread out. So the only way that prices can grow faster than household incomes is if there's other sources of wealth. But you find buyers with other sources of wealth typically in blue chip inner city locations. Other sources of wealth can include employee shares, inheritances, business profits, gifts, all these sorts of things. Really the wealthiest 20% of Australians will more likely have other sources of wealth. The remaining 80% typically, their capacity is driven mostly by their household income. And with respect to investing in property, the maths is really simple, right? This is not my opinion. This is just basic maths. Property investment strategy, the best one, is one that delivers the highest average growth rate over multiple decades, because then you're going to benefit from compounding capital growth. So, for example, if I buy $1 million property today, and let's say it grows at 6.5%, I'm being conservative, probably should grow more than that if it's investment grade, but say 6.5% over 30 years. In 30 years' time, that property will be worth $6.6 million. Hard to get your head around, but it does happen. That means I've gained $5.6 million of equity. That's a huge return, probably enough to fund most people's retirement. But it's the distribution and the breakup of that growth over that 30-year period that's most important to understand. Because in the first 10 years, I only enjoyed 16% of that $5.6 million equity increase, so $880,000. In the second 10-year period, I got 26%, about $1.65 million of equity growth. All my return, or most of my return, I should say, came in the last 10 years, 55% of it, almost $3 million of equity growth in that last 30 years. That is the secret to building wealth with property, is to buy something that's going to deliver the highest average return over a multi-decade period. Do it as soon as you possibly can, because you've really got to wait 20 years before you start really generating huge amounts of wealth, and then have the patience to hang on to that asset, hold on to that asset, and enjoy the benefits of compounding capital growth. Okay, so you know by now, if you've been listening to more than a couple of these episodes, I'm a nerd that gets nerdy about numbers. And so hopefully by this stage, you would have expected, look, Stuart's going to financially analyze and compare and financially model a scenario here to work out, how does hotspotting work as a strategy? Because again, I don't really care what strategy we use in terms of building plans for clients. It's really about using a strategy that is most effectual. Okay, so I've made some assumptions in terms of what a hotspotting property looks like, both in terms of price point and performance, and then I've compared it to a traditional buy and hold strategy. And I've looked at a couple of scenarios. I'm going to take you through those scenarios right now, but it might be sometimes easier to read this or look at it in text format. So of course, you can always refer to the blog on the website for that, because I have to throw a bunch of numbers at you. So let's start with the assumptions I've used for a hotspotting property investment. So I've assumed a $650,000 purchase price, a starting rental yield of 4.5%. So the $650,000 property is attracting about $560 a week. Mortgage interest rate of 6.5%, 30% of gross rental for all costs, managing agent, maintenance, all those sorts of things. Investors in the 39% income tax bracket, which is I think 135 to 190,000, sort of in that range. And after 7 years, the property is expected to double in value. The investor then sells that property, pays all the costs, repay the loan, CGT, all that sort of stuff, walks away with a bunch of cash, of course, puts that cash into an ETF portfolio, and then goes and buys another hotspotting property. And in fact, they do it 3 times. So they buy one today, hold it for 7 years, sell, invest the proceeds in a portfolio, buy a second hotspotting property, and then a third hotspotting property, which takes them to about year 25, because I'm allowing for the fact that there's settlement periods and selling periods, and it'll take time to find the next investment. So there might be a year's gap in between, and then keeps that portfolio running for another 5 years. So we're looking at a 30-year time frame, just to kind of compare apples with apples. So what we're really doing is building a whole bunch of wealth using the hotspotting strategy. We're selling after 7 years because we don't believe that asset will continue to deliver that level of capital growth. And then we're investing in a pool of liquid assets like a ETF portfolio, something that's more liquid, can generate more income, very passive, all those sorts of things. Okay, so what are the results? The results is that if I embarked on a hot spotting strategy just as I set out there, I would, in 30 years' time, have accumulated $1.45 million in today's dollars after tax. So that's accounting for all tax and so forth. And I will, in this situation, talk about numbers in today's dollars. Otherwise, they start to become a little bit unrelatable, and we want to compare relatively, like what would $1.5 million do? It would help fund most people's retirement or go a long way to doing that. And so it gives us that sort of context to sort of measure how effective the strategy is. So all numbers are in today's dollars, all after tax. So that 1.45 million, it consists of about 265,000 of my own contributions. So that's capital, because I've had to pay for the holding costs of the 3 hotspotting properties. And then 1.185, let's call it $1.2 million, is really my after-tax return, what I've generated both in the ETF portfolio and in the property itself. So pretty good outcome. But the alternative is to invest in a investment grade buy and hold asset, obviously something with a much lower rental yield, say 2.5%, but a higher rate of capital growth, say 7.5%, and then sell it after 30 years. And the cash proceeds I would walk away with on an after-tax basis, $2.35 million. So almost an extra $1 million in today's dollars than the hot spotting strategy, about 65% more in terms of total return. And that $2.35 million pot of money, about 550,000, so $500,000 is really my capital, because obviously I've had to put more money into this investment. And about 1.8 million is the after-tax returns from enjoying that capital growth over that period of time, that compounding capital growth. Now, it's important to note that obviously in the buy and hold investment grade property, my capital contribution, as I just said, was about 550,000, whereas my capital contribution for the hot spotting strategy is much lower, less than half, $265,000. So we're not comparing apples with apples here, because I've invested, more than double the amount in that. So I'll come back to that in a second and make some adjustmts for that. Now, this financial analysis that I just did assumes that the investor buys 3 consecutive hotspotting strategies, each of those doubling in value after 7 years, which is a relatively short period of time. Let's be clear, this requires perfect asset selection and perfect market timing. Now, I've spoken earlier about, some of the challenges with that in terms of the reliability of the data, the uniqueness of the data to give you a bit of an investing edge, all those sorts of things. And I remember sitting on a media panel a long time ago, it's probably sort of 10 or 15 years ago now, and a well-known advocate of the hotspotting strategy was on that panel. And before we actually started the presentation, just between the group of the panelists, I should say, she admitted that her accuracy rate with her own personal property portfolio was around 70-80%. So she was saying about 20 to 30% of the properties she bought ended up being duds. And so this is a significant admission, something that really, I remember today, obviously, vividly, because I couldn't help thinking at the time, and why would you embark on a strategy that has a 70-80% success rate? With so much on the line in terms of being able to meet your goals and, wasting time in a poor investment, all those sorts of things just didn't make sense to me at the time. So I don't think it's reasonable to build a strategy assuming you're going to have a 100% success rate. I think you've got to build in an element. I mean, hope that that's going to be the case, of course, but I think you've got to build an element to provide for that risk. So what I did is modeled what would happen then if the first one was perfect, the second one was less than perfect. So the property only increased by a couple of 100,000 over the 7-year period, about 23% total growth, if you like. And then the third one was perfect. So we're saying like 2 out of 3 are perfect. One of them wasn't terrible, but it wasn't what we expected. What's pretty sensitive, right? Instead of generating $1.45 million of wealth after tax, you'll end up with just a little over $1 million. Again, comprising of 265,000 of your original capital, so cash flow doesn't change, but the after-tax money you've accumulated, 786,000. So it's a lot lower. So it is quite sensitive to how accurate you can be with executing this strategy. And remember, you've got to buy into a market before that growth cycle begins, really. And there's risk. You could be too early or you could be too late. And so it can be a challenging process to be able to repeat with consistent accuracy every single time. Now, as I said, we're comparing a hotspotting strategy with a buy and hold strategy, but they both require completely different holding costs and therefore capital contributions. So we need to make an adjustment for that to compare apples with apples. So let me just remind you again, the perfect hotspotting strategy, $1.45 million. The semi-perfect strategy, I think, is really the one that is more realistic, because I'm not even suggesting the second one's a complete dud, just not as good as the other one. That's about $1 million of wealth, again, all after tax today's dollars. Now, if I look at buying half of a high growth investment property, which really equalizes the amount of capital that I've contributed, the amount of wealth accumulated is almost $1.2 million. So 20% more than the kind of semi-perfect hotspotting strategy analysis. And that $1.2 million is around about 280,000 of capital contributed. So very similar to the 265 with the hotspotting strategies, and about almost $900,000 of after-tax investment returns, which is about $200,000 more. So the key takeaway from this analysis, in my view, is that if you can afford to invest in investment grade property, a low income, high growth property, it's very likely to be a superior long-term strategy. But if the holding costs are too much, so you can't actually afford all the holding costs or the borrowing capacity, then a hotspotting strategy might be a viable alternative. And I'll underscore might there, of course, because the key thing is if you can consistently pick the right properties at the right time, and it's certainly a higher risk strategy, so you need to make friends with that. Now, of course, if you go and speak to a buyer's agent that sells these hotspotting strategies or promotes these hotspotting strategies, of course they're going to say, yeah, of course we can do that, etc., etc. But I know from my own experience, in terms of with clients and also that interaction with a client that had a very large portfolio, the success rate isn't going to be 100%. And I think it's unrealistic, again, to build a strategy that premised on the idea that it will be 100%. The other thing to make friends with is that if you are going to embark on a hotspotting strategy, it's probably not a buy and hold strategy. That is, if you can get in, if you get some good growth, I think continue to hold it. It's unlikely that a market completely falls apart unless there's only one source of demand. We saw that with mining towns about 10 or 15 years ago. Unless that's present, then there's not a lot of risk of holding sort of too long, if you like. But, if growth starts to level out, you might be better off just selling that property, crystallizing your gain. Yes, you got to pay some capital gains tax, but there's no point remaining in investment if it's not going to continue to perform well relative to other assets. And the final thing I wanted to talk about really, which is just a kind of time in point consideration, is that at the beginning, I highlighted that regional locations have outperformed more recently. And that's really been driven by COVID, the lockdowns and so forth, and then the affordability pressures due to sort of higher interest rates, reduced borrowing capacity, those sorts of things. But we know all markets move in cycles, and I talk about this a lot in this podcast, and the trend will eventually reverse. So investors today investing in regional locations could be exposed to additional downside risk over the next decade in terms of underperformance. So that's something else I would consider if I'm contemplating executing a hotspotting strategy today. Okay, let's get into some listener questions. First question is from Jacob, and Jacob writes, "Thanks for everything. You've single-handedly made me financially literate, and I can't thank you enough." Well, that's awesome, Jacob, and I'm glad it's such an important thing to become financially literate. I'm glad I've played a hand in that role, and I hope it sets you in good stead for the rest of your life. Anyway, Jacob writes, "My partner is a nurse and I'm a junior doctor. We're both 25 years old, earning a combined $170,000, living at home with minimal expenses, and we're wondering how best to use our surplus cash flow. Initially, I plan to buy an investment property as soon as possible, but I don't believe our borrowing capacity would allow for an investment grade asset. It seems our best option would be a house in Perth or an apartment in Melbourne. As a first home buyer, would it make sense to buy a home, a PPOR, with a 5% deposit, no stamp duty, which we have saved up, live in it for a year and then convert it to an investment? In episode 336, Campbell mentioned that a property with a 20% deposit needs a 5.4% growth rate to outperform an 8% return from shares. Given that you suggested in episode 299 that we can expect long-term about 5% growth from property, and in a recent episode, 10% from diversified shares, does gearing truly make up for the difference? Would I be better off investing in diversified ETF portfolio until we have more borrowing capacity for a higher quality asset? So, Jacob, thanks for the question. Just to clarify a couple of things, in terms of long-term property growth, I would think 4.5% to 5% plus inflation if you apply a lot of the fundamentals we talk about in this podcast, Campbell and I think is a reasonable expectation. Over the long term, you're not going to get that every year, of course. And in respect to diversified shares, you look at the very long-term returns, 20 to 40 years, they range between 8 to 10%. But, of course, shares are twice as more volatile as property. So it's entirely possible that you can start a share investing plan and experience a significant drop in value earlier on in your investment cycle or even no returns. And so therefore, if you're comparing, because of that volatility, if you're comparing strategies, I'd be a little bit more conservative with the return assumptions from a share portfolio when I'm comparing two different options like property versus shares. So in your situation, medicos obviously relative to, other occupations kind of under earn, I guess, for a period of time, maybe up to the first sort of 10 years of, since leaving sort of high school, if you like, because, you're studying longer and then you've got to qualify and do all those sorts of things. And then typically more than make up for it during the rest of their working career. So let's not all feel sorry for doctors, of course, but it gives rise to some planning opportunities, I guess. If you're a junior doctor and you're 25, I'm going to assume you haven't qualified in terms of specialist training yet. And really, for those that don't understand that industry, your income really ticks up, depending on what specialization you choose, but ticks up after that. So really for the next period of time, could be 4-ish years, I don't know, 3 to 5 years, call it. I'm going to assume Jacob and his partner's income isn't going to really change that much. I think getting into the market as soon as possible is really a priority you should pursue. Then you've got to think about, what's going to be the best in your situation. Of course, not paying capital gains tax makes sense, particularly if you can live at home and you can minimize costs and so forth. So I kind of like the idea of buying in Perth. I'm assuming that's where that's where you live at the moment. Buying in Perth, live in it for 6 to 12 months, keep all the records like electoral roll and rates notices, insurances, bills, all those sorts of things, demonstrate you were genuinely living in the property and it's your main residence. Then move back home if you can or you want to, and then put a tenant in that property. And from a cash flow perspective, you've got the best of both worlds. You've got the negative gearing, but the no capital gains tax on that property. At least it gets you into a market that, look, I mean, Perth's growth has been extraordinary. It's not going to continue at that rate, but I'm not of the view that it's going to, that if you buy a property today, in a few years' time, I think it's going to be worth more. How much more, no one really knows, but you're not going to pay, much in the way of entry costs in terms of no stamp duty, and there's no capital gains tax. And then you've got the gearing element. And I don't think it's going to be difficult to earn 7% compounding in Perth over the next period of time. So that's the key thing here. Now, I'm contradicting everything I say in this podcast because what I'm really suggesting to you is because there's a delay in your ability to increase your income, or let me put it a different way, because we expect your borrowing capacity to dramatically change over, say, the next 5 years, the only reason I'm suggesting this is because of that. And so what I want to do is get into the market now, get some gearing, at least you're invested, hopefully you'll enjoy some good gains. Then you can use that equity, whether you sell that property or whether you keep it, really depends on at the time. But then you can use that equity together with your higher borrowing capacity because you have a higher income and then leapfrog into a better quality asset. So it's a little bit of a short-term move here, and that's why I say it sort of contradicts what I talk about in the podcast. But strategy-wise, because your income's going to change considerably, and this is my assumption, so of course, if it's wrong, ignore what I'm saying. That's the advice that I'd give you. Sorry, information, not advice, of course, in the podcast. Okay, I think that's all I've got time for today. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions at investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.